Welcome to the Independence by Design podcast, where we discuss what it means to be a business owner and ways to get unstuck from the day-to-day so we can design a business that gives us a life of independence. What's up, man?
Nothing much.
I'm excited.
Me too.
Yeah, man. We don't have a short list of things to talk about. There's nothing going on. Very excited for the listeners that are not familiar. Joe, go back and check out last quarter's update. We actually, Joe, you did a great job kind of level setting some of the concepts of M2, a lot of the macro stuff that you and I care about. And the whole goal of these quarterlies is so we can jump right in. So they should go check out your Heresy Financial YouTube channel, which is always producing amazing content. I'm a big fan and groupie, which is why we're here. And I'm excited to hear what you are paying attention to, because I'm paying attention to a lot of stuff, but I think there's a lot of noise out there. Mm-hmm. I have a list in front of me. Where the hell do you want to start?
Oh man, I don't know. Give me the top three, and I'll roll the dice.
Maybe selfishly, what I can do, Joe, is just walk you through what's on my brain with all of the things that you and I probably consume on our own time. So the things that I'm paying attention to that I have no idea how this all unfolds, which is why I'm constantly curious about watching your stuff and listening to the people that I am, is we have a bunch of debt to refinance as a country in the coming months, like a significant chunk of those short-term treasuries at best it has to refinance. There's this Basel III rule that you have been talking about where the banks might change their accounting laws to then use the refinancing and print through the banks, to use short change of a word. And then I'm like, okay, all this is going to result in the M2 money supply growth going through the roof, which means printing. We're printing money that we don't have to keep the money going. That is, the debt is the currency. So when I look at that as a backdrop, Joe, it's okay, well, then there's everything else just exacerbates that situation where the debasement of the dollar that's happening through Doge completely shit the bed. The big, beautiful bill prints more money and actually increases spending. And we're going to have to refinance this money. And so all of this just leads into the debasement of the dollar and all the different trickery words that we can use. And what else I'm looking at is how this is kind of the level of intensity is the 10-year treasury for the US. And I've been watching the Japan yen market in the US, and I found my own fascinating takeaways from that because of how freaking fragile the bond market is. And Jamie Dimon came out and said something last week about that. So all that being said, I'm going the whole thing's just like a freaking tinderbox and they're going to print. I mean, that's Ryan's shorthand way of saying it. So all that being said, I mean, there's a lot of thoughts or where all that came from. I don't know if I'm on track, off track, but I know you're putting out very good, pointed, short content that relates to a lot of this stuff. Where do you want to start?
Yeah, I mean, I think the big shift that people need to get used to is to watch fiscal instead of monetary. And what that means is the treasury instead of the Fed. But from 2019 through 2021 or two, yeah, I think it was most important to watch what the Federal Reserve was doing, because they were monetizing a bunch of the debt. They were doing a bunch of QE. They were doing shenanigans with the supplementary leverage ratio with banks to make sure that there wasn't negative rates. There was a bunch of things that it was hey, we need to watch what the Federal Reserve is doing with monetary policy.
Can I add to just for the listeners that it's because they were playing their own different gimmicks of different, the repo, all the different things, the different mechanics that you just mentioned are different ways that their influence was impacting the borrowing rates and the what was going on. So there was a direct impact of what their decisions were and how that would roll into the economy, where now it's different. Is what you're saying.
Well, not necessarily that it's different. It's just not as impactful as it was during that period of time. That.
What changed between the two times where it went from monetary, what Jerome Powell's doing, compared to fiscal, where it's US Treasury?
Yeah, I mean, when you print 25% of the entire money supply within the course of a year or two, that's going to have a very large impact. And so when they're trying to deal with the fallout of the lockdowns and the extra borrowing, and they're printing to compensate for that, buying up all the debt, then they're having to manage the bank's assets versus liabilities so that rates don't get pushed negative. Everything the Federal Reserve is doing is having a huge impact. And then they're trying to say, okay, well, now we need to stay in front of inflation. And even though we caused it, all that. So that all eyes on the Fed, good thing. I think most people are still looking at the Federal Reserve and their impact. They've really, really dialed down what they've been doing to just try and minimize the impact. And you may disagree with that, but that's just, when you look at how far interest rates went up, how long they've been holding steady, the slight amount that they've gone down. When you look at the balance sheet, just slowly declining, and now that tapering is fading off. It's very little impact coming from the Fed. On the other hand, there's a huge impact coming from the federal government through the spending, the taxing, the how the Treasury is choosing to roll over
just
the debt.
Policies and even geopolitical, like all the conversations that are happening with Bassett, Ludnick, and Trump. I mean, to some extent, is that a fair way of putting it?
Yes. I think the tariff stuff and the trade deals are a little bit more of a distraction. I think the bigger stuff to watch, it's the fiscal policy, which is spending and taxing and borrowing. Those are having a much larger impact and will have a much larger impact than anything else for a while. So this goes to what you were talking about earlier, which is, they came in with a promise of cutting $2 trillion from the budget just from waste and fraud. Then they said, okay, we'll do 1 trillion. Then it was like, okay, well, over the next 10 years,
it was 134 billion that we had done. Yeah. Like, I used to have
the fundamental problem with that is that all government spending is by definition waste. So it's not as if they're going in there and they're saying, you can't go into that and say, okay, well, there's just a bunch of, we're spending a bunch of money on this thing and we could just swap it out for the same thing and save a bunch of money. It's like, that's not where the majority of the money's going. It's going to Medicare, it's going to military, it's going to Social Security, it's going to Medicaid. Like, that's basically the entire thing.
Well, and then let me just translate. Right. Well, it's like, let me just translate this for my listeners in my world, like, which is why it's so fascinating that I've landed on all of this macro stuff, because I just look at a cash flow statement. Like, you start with the balance sheet, you generate a cash flow statement, you should have more. That's how it works. Or you invest so you can have more. But like, all the while the balance sheet's eroding because of the money printing. But like, as a business, we have an income statement. You have a revenue, cost of goods, and overhead. The government is the overhead. Like, I mean, it is. And in business, Joe, like, all of my clients, 2 line items: payroll, rent. Like, that's the majority of a business. Like, in the expenses, the overhead. Yes, you've got like payroll, taxes, you got IT, you got marketing, you got all this other shit. But like, you have to, like, payroll and rent are the largest 2 items for most companies. And like, so you're not going to touch that shit, but you can't like get rid of IT or get rid of marketing. Like, so all these things are like necessary. But like when you walk through it, it's like the fact that, like, it's so pathetic to me, because like the fact that we just were like, oh, it's just gonna, like, we're gonna kind of fizzle off into the background. And then like Bassett comes out and is like, we're gonna grow our way out of this.
Well, that's the only option left. I mean, and that's the problem. That's the scary part, because there are only 4 ways to deleverage. And when you hit 120% debt to GDP ratio, you have to deleverage. Otherwise, you have real danger of tipping over into hyperinflation.
And so I want to hear, because you did a great video on the 4 ways. So like, you don't have to, like, we'll put the link in there, and so you can give an overview of it. And I watched it, but before you do the 120% debt to GDP, like what I've been, and I do a quasi poor job of explaining this to other people that aren't in the world like you and I every day, is it's a mathematical debt doom loop, is how it's like you're just printing to pay the interest. Can you explain a little bit more of like why that number,
you make $100,000 a year and you owe $120,000 in debt?
In interest or just debt? Because like, is it
Debt to GDP. Yeah. So that's like
Yep.
if you're an individual, you make 100 grand a year, but you've got $120,000 in debt. And
Payments, but payments are debt because, like, I think it's
debt.
back to cash flow, right?
Yeah.
But then, but are
The
with
debt
the
to
way
GDP ratio is the national debt compared to
that,
the size of GDP, US GDP.
yep, yep, yep,
So on a
un, un,
personal level, that would be like making 100 grand a year and you have $120,000 in debt and you don't have any assets. I'm not talking about not like your net worth is $120,000 negative and you make $100,000 a year.
right? Because the government doesn't have any. Because I think this is understood, and then where I then go to is then the cash flow statement, which is where I live every day inside of companies, where then we are printing because if we have a deficit the way that we do, we have to print it. Right. So that, like, we have to generate more cash flow as a country, which is taxes or growth
Yeah,
in order to
the
service
question
the
is how
debt.
they're paying for that. So right
Right.
now the deficit, which is the difference between taxes and total spending, that's the amount that they have to borrow each year that adds to the debt. That's 7% of GDP. So that's like they're taking an extra, you make 100 grand a year, you have $120,000 in debt, you have no savings, and you're adding 7 grand a year onto your debt. It's like that's not sustainable. And the other thing is, like, you can't just say, okay, well we'll just stick here, no printing, balance the budget, because all debt has interest. And so every dollar that exists has been loaned into existence has to get paid back plus interest. And so it's like, well, the US government pays back the debt that they owe by borrowing new money, but eventually you run out of dollars because you always owe more dollars than you initially borrowed. And so the interest it actually destroys dollars if debt actually gets paid back. And so the only way to prevent a deflationary death spiral, just a complete default, domino effect, is to at least print enough to compensate for the dollar destruction that happens during debt payoff. And they're always going to print a lot more than that.
So what I have been the things that I have been watching or like synthesizing that I think are different, because like you've shown charts on your YouTube, or there's in plenty of books where in the Great Depression and after the World War, the freaking, like, the numbers were similar. However, so like what they did then versus what we're at now, and I'm literally so curious, like, how you see this all unfolding. The Before 100 years ago, it was, we have a shitload of army vets coming back who can create stuff and we can tax them. We had technological revolutions that increased productivity while the vets came back, while women got back into the workforce. So it would be like quadrupling your sales force and generating a shitload more income so that way you can pay for the debt that you have. So, like, that right there is like the inverse of all of those boomers are retiring and dying. And we have a bunch of millennials and Gen Xers and Gen Zers that are broke, that can't actually get in their saddle with all this debt. So, like, the thing that got us out before, the like, when I hear Bassett and Elon say, or not Elon, he hasn't said that yet, but Bassett, well, Elon kind of did, but like, we're going to grow our way out of this. It's like, while all these 40 million people are retiring, like, it makes no sense.
Yeah. The other thing that happened during the 40s and the 50s was a lot of even though there was a productivity boom, there was still an inflationary deleveraging because they printed their way out of it. So there was yield curve control for years where the Federal Reserve pegged interest rates lower than the rate of inflation so the government could borrow at a rate lower than the rate of inflation. It was outright, like, it was policy. It wasn't like undercover or anything like that.
Yep,
There was outright yield curve control, and
which is
so
just legitimate theft from the people.
from any savers, wage earners, absolutely. And so you have to do that. And when I say have to, I mean, if you're not going to do austerity and you're not going to control the budget, you're not going to control the spending, um, the
And you're not going to default. Like,
and you're not going to default, then you have to print, and you do that through yield curve control, quantitative easing, things like that.
so, sorry, go ahead.
The way that you stop prices from exploding into a hyperinflationary territory, though, is to pair that inflationary deleveraging with a productivity boom.
Right. And okay, so let's pull off of a couple of those concepts, because I think I'll be able to tie us back to then the monetary shift to the fiscal shift. And then there's a couple other comments that I got is if the growth is faster than the debt accumulation, the payment, then yes. And like that's where like Raw Paul and like Besser, like we gotta grow our way. It's like just Hail Mary to AI. Like who cares what the repercussions are? And it's kind of this blind, like hopefully there's a singularity in 3 to 8 years. It's like, okay, well, let's take that aside and talk about like knowable things. It's like, okay, we the before or when you were saying like the yield curve control, because it took me a long time and a lot of research to better understand that. And so that is where the federal government, the Fed, is saying, here's what the rates are, but the borrowing rates for everyone else are more. So can you make and that's where the 10-year I think comes in of like what, like regardless that the Fed has reduced the rates a little bit, the 10-years continue to go up. So can you explain like why that's good for the government and why it's okay for them, but why that reduced rate doesn't actually make its way into the economy and how that benefits the government?
Yeah. Right now, the government has to borrow from a lot of real people who are making real decisions with about profit and loss. And so if I, as a potential lender to the government, am thinking about, okay, the chances of inflation in the future, my other areas that I could lend money to, what is going to entice me to lend that money to the US government? I'm going to need at least X percent of an interest rate, of a yield on my money. And so the worse things get, the more inflation people are predicting, the higher rates other people are paying. That means the government's going to have to pay higher rates if they want to borrow from me because they're competing with everybody else. Yield curve control just means that there's somebody that steps in and says, I don't care how much the US government wants to borrow, I will loan to them at 1%. And the way they can do that is because they're the money printer, and that's the Fed. That's all yield curve control is. The ironic thing is that everybody else looks at that and says, okay, well, if the government can borrow at basically free rates, that means the money supply is going to expand rapidly. That means inflation is going to go up. That means if I'm going to lend to anybody else, because I can't lend to the government at 1%, definitely not going to do that. And they're not going to borrow from me at 2% because they're borrowing from the Fed at 1%. If I'm going to lend to anybody else, I'm going to demand at least 6, 7, 8, 9,
12.
10%,
Yeah, I mean, like it should
whatever
be.
it is,
Yeah,
depending on,
right, right.
yeah, exactly, depending on the type of loan for sure. So, so when yield curve control happens, the government gets to basically, it looks like debt, but it's printing.
Money
And
printing. Yeah.
that drives up the cost of borrowing and the cost of doing business for everybody else.
It's a complete F job. And so the I mean, it's why Michael Saylor says, I mean, if you have got bonds in your portfolio, you've locked in toxicity. That's how
Yep,
he calls it. I mean, it's
bonds
like
are return-free risk.
it's return free risk.
Yeah,
Like
normally
so,
bonds, people say
yeah,
bonds are, that you have
risk-free
risk-free
return.
return there. No,
Yeah,
they're
return.
return-free risk.
Yeah. I it's so interesting to me, Joe, because like I've personally orange pilled probably 3 dozen people in the last 6 months. Um, because it's like I'm getting better at of explaining these very complicated topics. It's just like they're stealing our time. You work all this time and then they print money and then they steal it. Like, and as a business, you start with a balance sheet and you grow, and then there's constantly chipping away at the foundation that you started on. And so that's what a bond is. Like, so you're investing in these bonds, so you go get 5%. And like, I immediately can find someone's like complete ignorance. Like, yeah, I got 5.5% on my bond. I'm like, you're just bragging about how you're losing money. And so M2 money supply growth and like the global liquidity M2. So I'm going to go back into this and I'll tie it back to the fiscal dominance. So that has become, a big popular chart from Raul Paul from Real Vision, and the global M2 liquidity, because Bitcoin becomes, all these asset prices are like global now, and like you're starting to see the asset, so the Nasdaq and the S&P 500 and the price of Bitcoin and a lot of the gold are following the liquidity. So as the money is flowing into the system, the prices are going up of these assets because people don't want their money eroded. If you heard of so Mark Moss is I don't know if you follow with him at all, but like he does he cites Capital Wars, the newsletter, quite a bit. You familiar with that one at all? Um Great. It's all about cycles and the debt cycle. So he was talking about every 48 months or so, there's that 4-year debt cycle that has to be refinanced, back to what you're saying. So there's this whole liquidity cycle that's driven off of refinancing. And they literally, the whole system can't, because it's now so like 75% of the money is tied to collateral, and the collateral cannot go down in value. Otherwise, the whole market explodes. So it's like this process of printing money to refinance to print the money. Like, and it's just, anyways, Capital Words, I highly recommend checking that out. But therefore, it's now going to the US Treasury, say, how are they handling this? Right? Because if the Fed, like you said, is not as impactful with their tools, we're now going to the Treasury saying, okay, is there yield curve control? And like, talk about this Basel III and the yield curve control, and like, how does the actual government get out of this? Because it ends up in debasing the money, like we're talking about. Like, what should we be looking for on the 10-year Treasury, the Basel III, like how, like, and what the supply growth of this money is, and like the extent of it.
Well, like I said earlier, I don't think it's going to come from the Fed. So I wouldn't watch the Fed's balance sheet, at least right now. I wouldn't watch the repo rates. I wouldn't watch um, even the federal funds rate is not, at least right now, going to be. It's not going to be moving that much. You're not going to see the Fed funds rate go back down to zero anytime soon. Probably for decades. Um, the the big things to watch are going to be whatever the spending bill ends up being. That's going to be a really, really important thing to look at the details of. Number one. Number two is going to be, within the next couple of months, they're going to probably deregulate the banks. So right now, banks are restricted in how many treasuries they can buy, which makes sense because think about Silicon Valley Bank. They buy a bunch of treasuries when they're yielding 1%. Interest rates go up. Now they're sitting on a bunch of losses. All the depositors go and say, "Give me my money back," and they can't sell enough treasuries in order to meet the withdrawals because those treasuries were at a loss.
And how I've been communicating that to my ownership community is, can you imagine having a shitload of inventory on your balance sheet that's in your warehouse that is not worth anything, but you're keeping it there at market rates so you can get bank lending from your bank? Never done that before. And like everyone laughs. It's like that's what they're doing. Like they have the treasuries are underwater because if they were to sell them, they'd have to compete with the 5.5%, and they got 3. Right. So like, and I think it's just so interesting how like put into those terms of inventory, like of the business, people are like, I get that. Wait, what are they doing?
Yeah. Yeah, exactly. And so the way that was dealt with, that problem was dealt with, was saying, okay, well, if it's treasuries, um, treasuries are risk free as long as you can hold them until maturity. So if you can't hold them until maturity, you can temporarily sell them to the Fed for full price, even though they're not worth that much. Fed will buy them at full price, as long as you buy them back within a year. So it's like, I've got a house. I bought it for $500,000. Right now it's worth $300,000. I could sell it to the Fed for 500 grand, even though it's not worth that much, as long as I buy it back from them within the next year. It's like, that's a pretty good deal. So that's the deal that the Fed worked out with the banks in order to deal with the treasury problem, so that we didn't get a bunch of bank.
What happens when that 1 year mark comes up and the thing is still
it's
left?
gone. It's done. It's gone. The 1 year, they were all bought back, because essentially when money printing is there to supply the dollars that are not actually there, then you no longer need to go get your dollars. It's like, if the bank has your money, you don't want to get it out. If the bank doesn't have your money, you want to get it out. So it's kind of like a catch-22 a little bit. But once the Fed
So they
steps in
did,
with that,
they didn't have to go back and buy them then?
they did all go back and buy them, and they were able to because the bank run stopped, the deposits started coming back in again, and everything was fine because of that implicit
Yeah,
bailout that
yeah,
was
yeah, yeah, yeah.
seen
Because
in the
they just
United
needed the
States.
liquidity. They don't care about the undervalue. So that would be like for the listeners in here, they have inventory from their manufacturer. They say, wait a second, I can't sell any of this stuff. The manufacturer buys it back. They can. I mean, the whole thing is just such a like because we just live under like completely different rules that are. It's just so ridiculous.
Yeah. So because of that whole thing, the banks are about to be deregulated so they can buy more U.S. Treasuries, because right now Treasuries are considered like a risk asset that if they buy Treasuries, they can only have a certain number of them compared to everything else that
Because
they
of
have,
Silicon Valley, because it
because they might go
impacts.
down in value and they might,
Mhm.
experience a bank run. But now that we have the precedent set with the BTFP and the discount window and some of these implicit guarantees, bailouts that are waiting by the Fed, the government's going to come in and say, "Hey, banks, you can buy as many treasuries as you want. We're not going to restrict you. You can load up." Um, and that's a sweet deal for banks, because for the banks, treasuries then turn into risk-free return because they loan money into existence. So they can just load up on as many treasuries as they want. And now, temporarily, the government then has enough buyers of treasuries for them to roll over the $9 trillion of debt that's getting rolled over in the next 9 months.
I just like so I on that image on X that was floating around of like the bank's illiquidity of like the half a billion or half a trillion dollars of like what their balance sheets look like. I retweeted, and again, I've like got no followers, so like it just goes into like the void, but it still makes me feel better. Is like is so in that situation you just walk through the thought because I absolutely hated my commercial banker. Like that's why my dad and I ended up selling it. The whole great financial crisis, like banking was shut down. That would be like the 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 bank coming to us and scrutinizing our inventory and our loan, like our lending capacity while they're fucked. I just want to go like, here's my middle finger. Give me the fiat free money. Like it's like the hypocrisy is so disgusting. It's like the parent that tells a child what to do and then does the exact opposite. And it's just like, it's the world that I don't want to live in. And it's like, it because what you just said is saying ignore your inventory. So that would be like me going to someone that's listening in and saying, here's the deal. That $2 million of obsolete inventory that you have right now, how about we just go poof, it's gone. And now you can buy $2 more million of Canon's inventory because Canon needs to keep going. I mean, it's just like the whole thing is ridiculous. Yet we are playing by completely different rules. Like everything has to be marked to market. Everything has to deal with like actual cash and cash flow. It's just so insane. So they're gonna like so what you're thinking is as they deregulate and with this Basel 3 or whatever it is, so then the banks will come in and be the ones participating in the auction for Bassett and the Treasury.
Yeah. Yeah, for sure. Um, Now the question is, will it be enough? I think it will be, at least for the next 6 to 12 months. And then after that, then the question is, what's, how are they going to handle it?
Where's the
Where's
next
the next
sucker?
batch going to come from? Yeah, because it's only going to accelerate. So, and then you get into, okay, well, if we're looking at the longer term here, they're doing this as a short term band-aid. And then the longer term
Mhm.
bet is that we can do tax cuts and deregulation elsewhere in order to make
Get that
the
growth.
economy grow. And those are some big bets. They're not impossible, but they are some big bets.
Um, so I'll go back to like my thoughts about the big bets of like of the growth, but so let's say they were able to jam down this $9 trillion on the bank's throats. So what we'll see is M2 global liquidity grow is what we would like how we see that because we're not going to be able to look at the Fed balance sheet, right? We're not looking at the Fed fund rate. We're looking at the 10-year treasury, which and I want to go back to like why that's such a good indicator. And maybe I start with like my articulation of it and you can kind of course correct me on it. But like that's how this is going to happen. So like it's silent. Because no, like I mean, how many people are listening in? If people are listening to this, they're already to the right of the decimal point. I mean, and like is there, even if someone's looking, they're going to look at the Fed balance sheet at Fred, and they're not. It's like but the M2 money supply, like we're debasing the dollar that we save in because we're having more of them printed. And so like you say that it'll, work for the next 6 to 12 months. But what I think is so crazy, Joe, is like, and why I think the growth story is like, there's a chance that AI, sure, there's a chance that like 1 million of Americans out of 330 million are productive enough to generate enough cash flow for everybody. I don't know. That seems kind of insane, but like, I mean, the money should go to the people that create the value, but like, there's a whole thing of the Pareto principle with AI and growth and cash flow, where who's actually getting it and where's it coming from, and can it outpace the money printing? But the real demographics is like, there's a shitload of old people retiring every day. like my mom and dad, and like a lot of the clients, half the clients I work with, half of them are my age, half of them are my parents' age. And it's like, I'm out. I want my Social Security, my get Medicare, Medicaid, and I want to, suck my money out of my retirement. So like all of the pools of capital are going to get smaller while our expenses at the government grow, which is why like Peter Zion and like the ITR economics in 2030, Paul, like it's the inverse of what we were talking about with the world after the last war. And I'm just going, I just don't. So how does this keep going, dude? Like I don't know.
Well, a couple of things. So for a very long time now, only like somewhere around 40%, I believe it's a little less than 40%, of the total population is actually employed. So like you can't look at
40%? Is that what you said?
It's under 40% of the total US population is
babies, retired people, or what?
Yeah, and just people who were looking for jobs that have given up. I mean, yeah.
40%?
So you don't, I mean, think about it from a family unit level. You've got a family of 4. Traditionally, one person has to work to support a family of 4,
yeah.
right?
Yep.
Maybe 2. So you get a bunch of families together. The average number of workers there is going to be 25 to 50%. So 35 or so.
Fair, yeah.
So it's I'm not convinced that the boomer generation retiring is a massive deal to productivity for a few reasons. Number one, by and large, younger people who've been in the workforce for a while tend to be much more productive, especially compared to the cost, than the boomers. It's like
fair
for a lot of jobs. It's like, man, you were born in a different generation. Like we can run circles around you with how productive we are given the tools that we have.
What? GPT?
Yeah. So there's that. Number 2, most retirees have their own pools of accumulated capital that they are drawing on. I mean, they are taking from Social Security and Medicare and things
otherwise
like that,
they don't retire.
But actually the numbers of this are insane. 56% of retirees do not pull even the growth from their retirement accounts. They're not touching the principal, and they're not even pulling all the growth, and they're already retired. That's 56% of retirees. Another 24% don't even touch the principal. So a full 86%, I believe, is 84, 85, 86%.
So they're not depleting the savings.
Don't touch the principal at all. Only 14% are 14% are pulling from principal and interest, and that means they're definitely reliant on Social Security and Medicare.
And because of the Pareto principle of the aggregation of productivity towards those people, they're probably a small percentage of the people that are working. I'd like to layer that data on top of how many Americans, because it's the whole like 60% of Americans can't afford $2,000, 60% of Americans have a 6th grade education. So all those people you just talked about have enough money because they're the ones with the money.
They're the ones with the money. Yeah. And so them leaving the workforce, I don't think it's going to have as large of a negative impact as most people are anticipating, because they're going to be most of them are going to be living off of their accumulated capital. And so they're not going to be tipping this balance of, hey, they're sucking all the resources away from the younger productive people. So that's number 1.
Let me challenge or throw a data point in there that I would want in order to see the full picture is middle market, lower Main Street business owners specifically Main Street, and I've done a couple podcasts about this recently. So like mine are middle market clients that you've met, the $5 to $50 million. Like there's a real substantive, no, substantial business there. Like there's enough cash flow and stuff going on. Like you can put some leverage on it. You got some flexibility, but like 95% of companies are below 5 million in revenue. And you can't put any debt on those companies to facilitate the transition. So there's a lot of these people, Joe, that I'm seeing that like they're freaking tired. They've got 250 to 500 grand, maybe 700 grand saved up, and they're super tired and they're 70. And like the whole business is not there when so like I don't know what the implications on the economy of this are, because that's a big tax base right now. But again, the taxes aren't servicing the debt. So I don't know. I just would like to see that going. Like there's a lot of productive people out there right now that don't have a lot of savings who are very instrumental to the value creation of our economy.
Yes, I'm definitely not making the case that it's all, hunky-dory and peachy and unicorns
I never
and
thought
rainbows.
that.
I'm just saying, I think the narrative that this could
interesting perspective.
collapse the economy just because of boomers retiring is overblown. It's definitely nowhere near the problem in like China, where you have one person working for every like 10 people who can't work anymore. It's a nightmare there. So it's not there. All right, so the second thing is the deregulation. So there's, I think the big one is energy. So energy is the foundational input cost to everything.
Almost, yep.
Like there is no more fundamental lever that you can pull on than making energy cheaper to try and allow growth to happen. So much so that when you plot energy consumption on one axis and GDP per capita on another axis, it's a direct line. In other words, there are no rich countries that don't consume a lot of energy, and there are no rich countries. There are no poor countries that do consume a lot of energy. The more energy you consume, the wealthier you are per capita, not just overall. It is like the correlation. There is no tighter correlation. It's almost 1-to-1 energy consumption. And this goes back throughout all of human history. The more energy we've consumed as humanity, the wealthier the world has gotten. Because it is the input cost to creating everything that anybody wants and needs. And it is the input cost to delivering everything that everybody wants and needs. There's nothing more fundamental than that. And that is a big lever that is starting to get pushed on right now. That if they continue the deregulation, and allow, like with nuclear especially, to flourish, that's going to be a huge contributor to growth that at least somewhat will offset the pain of inflation. Because if something,
what are the timelines of like solar versus wind versus coal versus hydroelectric versus nuclear? I mean, like I was listening to Chamath on the All In, and he was talking like, I mean, it's like 3 years before he can even like break. I think about like even nuclear. I mean, you're 20 years away if you start it today, and then you start to hear some of these regulation. And so those numbers that they're talking about is because of the regulation. It's not because of
this is old tech. We know how to do it. The Navy has been running 6,000 reactor years accident-free. Like a combined 6,000 reactor years of nuclear energy production, 100% accident-free. Like it's not a new technology. We know how to do it. The only reason it is high cost and high time to build is because of regulation. And it's because during the build time, the regulations change every 6 months or year, and they have to go back and they have to rebuild parts of it and start over. And it's like a lot of these projects get stalled out because they're like, well, we can't go back now. It's done. It's dead in the water.
So me and my buddies that went to the Bitcoin conference in Vegas, we did a stop at Hoover Dam because my friend Aaron loves the Hoover Dam. 2 years. They built that thing in 2 years, and you're just like, you couldn't fill the paperwork out for that thing in 2 years. It was like 40 or $50 million, 2 years, 24/7. 365. Yeah.
The paperwork is a great example because the new executive order on nuclear just put a cap on the amount of time that it would take to get approval for a new nuclear power plant, and it capped it at 18 months. It's like, just to get approval. That's it was taking longer than that.
Right.
So
Right.
yeah, that's
So energy
big
could help with it. Reduction in energy costs increases productivity and cash flow. I mean, again, banking on the growth. I just, when I look at the financials, it's just like it just looks. It's just, is it just like a slow, like 8% debasement every year?
I don't think it's consistent. It's definitely, I mean, you have one year where it's, 25, 30% all at once. And then you have, you actually do have some years where it's like a lot less than that. So it's very volatile. But here's the thing. It's not that we're looking at these things and I'm speaking like, devil's advocate trying to say, okay, here's the case that we could have, outgrow the debt problem. It's not that you're going to say, okay, well, we're going to have such explosive growth that will pay off the debt. That's not the goal at all. The goal is, yeah, we're going to get to 100 trillion in debt, but we're going to have such explosive growth along the way that you're not going to have to feel the pain of that your quality of life will generally be the same and get a little bit better. So it's like somebody who has, makes 100 grand a year and they have, 30 grand in debt. And then they're like, well, I'm going to take out another 20 grand to get these certifications and these skills. My debt increased from 20 grand to 50 or 30 grand to 50 grand. But now my income increased to 150 grand. So percentage wise, I don't know if I did the math right. Maybe you're,
no, I'm tracking. I mean,
you're saying percentage wise that it's like my life actually improved a little bit, even though my debt went up because I was able to improve my income. And I think there's a very good chance that as long as they don't screw it over with regulations, I think AI and robotics in particular, because nobody wants to do those jobs. There's factory jobs. There's like 1 million factory jobs open across the US right now. It's like, you try and bring those back to America. Nobody's here to do those jobs right now. So I think the automation from robotics will have a big depressive force on prices of final products, which offsets the inflationary forces of printing.
Yeah, I know. And it's just like what I hear, and I don't know, I'm really trying to understand my own perspective on this, kind of like before we hit record, just having these debates with yourself. It's like, okay, like, of course, like I would love for us to be that productive where like we have additional cash flow and everybody's living a hunky-dory life. And like, but it's like the chances of, it's like when I built, like watching someone build a revenue forecast, and like probably more specifically a private equity revenue forecast, like the sun and everything aligned and there's a beam from the heavens, and we're like, this is the this is the forecast. It's like, would I love that? For sure. And I just look at the math of the printing and the demographics, all of it just kind of just coagulated together, going like, I mean, Lynn Alden's phrase, like, nothing stops this train. I read her book, Broken Money, recently, and it's just like, do you see, because I'm a Bitcoiner. I mean, that, like, as like, let me go back. All of the countries that are dealing with the same situation, China and Japan and like the UK, like all these demographic cliffs that are happening, and their central governments are all printing to just overcompensate for all this. Watching what I watched with the Japan yen, of like how leveraged the market is, where that thing wobbles and it blows up the US. I mean, I won't even get into it right now because I've like went down that rabbit hole. It's like all these central banks are like drunken sailors drinking, leaning against each other. So as long as they all keep drinking and keep leaning in relationship to each other, they're fine. But if you step outside of that, the whole thing, is like, do you see like a repricing or just a, like a slow move to something like Bitcoin, a neutral reserve asset where people can like They all agree we're going to print over here, but over here we're all going to stack Bitcoin to prepare for the shift over time.
Yeah, I mean the central banks coordinating and coming up with the cooperation rules of hey, if you print too much then it's currency manipulation, but if we all print at the same rate then it's not. It's like that just helps compare to each other and that helps the trade. That doesn't really do anything about the value of the currencies versus stuff. Yeah, stuff and assets. And so far, still there is the largest monetary asset is gold. I mean, central banks around the world for years now have been stockpiling gold at record paces for like 5 years now. Um, and it tends to sniff out big moves coming in the future because it's the big players who are stockpiling it. And over the last year to 2 years, it's up like what 60% or something like that. And it's sniffed out the money printing and growth of the money supply that's starting to happen right now. Uh, in terms of Bitcoin, it could absolutely displace that at some point in the future, but it's a lot longer of a path than I think a lot of people assume. It's not like a 1 year, 2 year. It's not even like a 10-year thing. These are long-term games. I mean, even just the dollar becoming the global reserve currency, it really just it was decades of slowly getting used to. It was gold first, and then it was paper that was redeemable for gold, and it was paper that the value was backed up by gold because some people could redeem it for gold. And then that's a decades and decades and decades long process. Um, for a new monetary asset to displace the old one. Um,
But what happens if, like, when you're as a capital allocator, you're going, everywhere I put my money is shit. I mean, like when you go through, like, by the way, did you check out Michael Saylor's? He did a keynote on treasuries. It was like a month ago. Unbelievable. He walks through all the stocks, all the different types of companies, the returns that everybody got. Did you watch that one by chance? Oh, dude, it was just like mathematically, like even the Meg 7 is a little bit above the capital erosion or cost of capital, and they export their dividends back to their shareholders who get screwed. And it's like there's this like, but he walks through the whole math, and it's like, at what point will the smart money go, like, this is a screw job, and I need to go somewhere else into other things? Or I mean, obviously the smart money is already doing that. And like, is it just the pension funds and insurance companies and endowments and the people that are just going to break all of this on their back? And then people are just going to get their savings stolen because they can't fight back enough, I guess. Cause like then how this all shows up is people don't want to lend to the treasury. Right. And so then the rates get high. I mean, I don't know. I bounce back and forth of all the different scenarios and just can't see, like, is this just literally just a slow boiling frog and people just have like worse lives every day? Like, that fucking sucks. Like, I don't know.
yeah. I mean, if you pretend that we have a static economy, then yeah, the debt and money printing dynamics just slowly erode the quality of life. But that's not
You're
that's
back to growth. You're a growth guy. Like, you think that the
I'm not
growth
even talking
will
about the speculative growth. I'm just talking about the way that the world actually works today without any guesses on how it'll
Mhm.
work in the future. Um, the reality is humans by definition in order to be alive produce more than we consume, and most of that production is done by a very very small very tiny group of people, but overall we produce more than we consume because you can only consume what has been produced, and if
Mhm.
we consume everything that we produce
We wouldn't have
then
stuff.
we wouldn't have anything.
Yep.
Um, and uh, and so we by definition we have to produce more than we consume, and we do. So the static economy doesn't exist. It's always a battle between production and consumption, and government policy is always on the side of consumption. Well, destruction, but some of that is consumption as well.
Yeah, yeah.
And the only way that we still exist is because the production has always won the battle so far. I think there's a good case to be made that that will continue. That does not always happen. There are places that do collapse.
And so like that combined with yield control is the way out, is what you're saying. So that plus yield control, so the government can melt away their debt in relationship to the size of the economy.
Well, that's the way it's going to happen. The real question is, what will the quality of life look like through that process? This process is going to happen. We're going to continue to have growth, and we're going to have yield curve control. We're going to have debt monetization through the banks. We're going to have more QE in the future. We're going to have inflationary deleveraging. The question is, will we produce enough to offset the pain? It's happening either way. It's just the question is, what will the quality of life be? So yeah, if the quality of life starts to get worse and worse and worse, then people naturally look for alternatives and eventually stop using the dollar that's been ruining their lives, and they start using a different currency instead, which means if a government wants to maintain power, they have to use the new currency instead of the old one that they controlled. That's what has happened through every major currency destruction in history. The Weimar Republic, when it collapsed, the government didn't choose to go back to gold. They didn't have any purchasing power. Nobody accepted their paper. Everybody was using gold on their own. And so they said, okay, well, I guess we have to go back to using gold, and we just don't have as much purchasing power as we used to.
Yeah, I track you. It's I guess I generally agree with all those points of view. I just, where I get hung up on is because I live inside of cash flow statements, and like I just live in the world of like there's actual rules behind, like if it says zero, you can't do anything about it. And you have to like pull some levers. Like when you look at the government, I mean, just the fact that they're balancing the growth with that debasement is the balance that you're talking about. And how painful is that? How fast do you grow? How much do you overconsume it? And like, and I think where I probably lean more towards Joe is like, how are actual people going to deal with this? Like, I mean, I'm telling you, man, like I was just camping with 12 families and 30 kids, like I was telling you about. I'm the only, or two other entrepreneurs in the group. Everybody else is W-2 workers. And they're all like, I was actually, is wild experience. I was sitting at the bonfire. Everyone's at the bonfire. So you got 25 people, 24 people, all of them double income earners. Like every single one of them. And like pretty well off people. And like, no one's going, yay, it's awesome. Everybody's like, fucking daycare is $4,000. You know, they got this, you got like, and everybody's trying to figure out, pick up after, and everybody's executives for the most part. You're just going like, this is like, and everybody goes, what's everyone else doing? And then everybody's trying to figure out how to employ their employees, going like, hey, trying to get someone excited for $75,000. That's like beer money now. I mean, like, so, and I think I'm just maybe so different than like a normal worker where like I can't imagine just accepting that pain. And that's probably the pain you're referring to. And I don't have a good, clear vision of like what kind of acceptance people have for how much they're getting stolen from them.
Yeah, I mean, I don't know if anybody could ever answer the question of like, how will everybody? It's like the question of, can everybody be rich? It's a philosophical, who cares? It's, can anybody be rich? Yes. It's just a matter of doing the things that produce the outcome. So,
but like employees, Joe, like with my clients, it's like the executive level suite, the inflation is off the fucking charts. And we're going like, because like my clients are getting squeezed from both ends. It's like, pass on the inflation to the customers. It's like, okay, well, I mean, I've got clients in building products or electrical contractor or boilers or like you name it. And it's just like, there is a top stop of like my house I bought for $500,000. It's probably worth 900 now. Like, is it worth 5 million at any given point? Like all my wife's employees, no one's getting married. No one has a house and they're just like, okay with it. Like they might have a car because they're in their 20s and they're like getting paid 75, 80 grand. Like they're fucked. And I'm just like, is like what happens when like that literally, like we can't get people excited enough to even work because it's just not worth it. But like, if we increase the cash flow or increase the payroll, because I even said that, because like my clients, out of anybody, it's like, if we can see into the future, like I said, hey, if we have the data, like what if we just went whoof and 25% raises? Could we actually attract the people to do the work? because now the war on talent as the boomers are actually retiring is very real. So I don't know. I'm just watching all this and I'm going like, this is just not rosy on like many fronts. I don't know.
Have you there's a paradox thought experiment. Like if you need to go one block, you might walk. You might jog or run if you have to get there fast, but it's only one block. You're just gonna zip on over there real quick. It might take you a couple of minutes. But if you have to go a mile, probably just gonna hop in the car. It's gonna take you like 30 seconds. So the paradox is that if you are in a worse situation, it compels you to take different action that likely results in a far superior outcome. If I'm making 75 grand a year and I'm able to get by without like going deeper into credit card debt every single month, I may not have the courage to leave that job and try to do something else that, you know, might turn out better down the road.
The
But if I'm
constraints
making
provide the
40
opportunity.
grand a year and I've got massive expenses, it's like, well, I'm already broke. Like if I quit my job, it's not going to actually be that worse. And that forces you to take actions that may actually result in some far superior outcome. And I think that underestimating, especially the American culture, the average person's will to survive and thrive, I think things get a little bit harder. It's like, well, we're going to have to make some very big changes that could end up being very, very good down the road.
I mean, I can get bought into that narrative because like that's my belief. I mean, that's my operating system. I just what challenges I see is that like wages are the trickle down of the inflation. It's wages 24 months after the M2 grows. Right. So like by the time the person's asking for their raise for 3% that they're not getting, there's already been an 8% debasement or whatever the fuck it's been. And so like what ends up happening is like they're literally perpetually behind. And what I've personally witnessed is I don't see myself making $180,000 anytime. So like whatever. So the productivity has dropped so much in the employee workforce because they're like, it don't matter. Like salaried employees are now like pretending they're punch out cards. It's like, it's literally 501 and I'm done. Cause like there is a transaction here. I'm an employee. You're an employer. I don't owe you anything other than my time. And so like, I'm just watching this and again, it's just my own microcosm, which is why I enjoy talking to people like you is like, that gets worse every year. And like the executives that you used to be able to get a good executive at 150, 175 grand. Now it's like 250 for the like, and you're like, okay, well, how like can the company's cash flow afford that? And it's become hard. And maybe as the big print happens over the next 12 months, maybe the business owners are the best ones that reap those rewards and then they can increase the productivity and it overcomes that. And I don't know if what I'm experiencing right now, Joe, is just like the tail end of the money supply shrinking over the last 2 years, where like people are kind of sucking wind before the next big print. Could be that. I'm just trying to like look at all angles to understand the momentum and trajectory.
One thing that we've left out of the discussion so far is that one of the primary drivers, 50% of it, that will lead into the next big round of printing and money supply expansion is tax cuts. So there will be quite a few people who have a lot more money left in their paycheck at the end of each month. And the other side of that is that prices of regular stuff is going to go up. But it's not like 2020, 2021, where it's just that the price of regular stuff went up. It's also, hey, I have more money now in my pocket, even though I didn't.
Well, who's the price cut? Who's the tax? Like, what's like the actual tax cuts? Isn't it just locking in what it was before? Were there any nuances of the differences? I haven't scoured through it.
I I don't, as far as I know, it's not completely done yet because there's been so much pushback recently that
Hmm.
there might be changes to it. Um, so I don't we can't say for sure yet. Obviously, if it's locking in what the original Tax Cuts and Jobs Act put in place,
Yeah, that's the same.
it's
Right.
not going to be, well, there are a lot of things that it's like bonus depreciation
Hmm. Hmm. Hmm.
and expensing, like bringing back those to 100%. Like
Yep.
that's going to unlock a lot of spending power for businesses,
Yep.
which
Yep.
hiring raises all that, like that
Well, and
directly.
honestly, on M&A, like if you can write off a transaction that you bought this year, I mean, that's a big deal. It's a
It's a
huge deal.
huge deal because you don't have to pay taxes on money you don't have anymore. Like, that's weird that
What a
that would be
concept.
helpful. So yeah, things like that are very, very beneficial, um, to helping deal with some of these problems. And we didn't talk about that, but it is substantial.
This has been fun, man. I know I'm probably on borrowed time. We just hit the hour mark. So helpful for me. Like if it's helpful for me, I'm hopeful it's helpful for everybody listening in because I'm usually the person trying to triangulate what everybody like you and Sailor and all the other people are saying. And like, I mean, these are people listening in that are just trying to make bets on where to invest their time and capital, making sure that they're not putting it in a place that's going to get eroded. So I think
Yeah.
it's helpful. Anything else that we should put on the docket to make sure that we revisit next quarter? Like, I mean, what are you paying attention to as like as we look back in 3 months? You're going, okay, here's what I'm going to be eyeing.
Yeah, I mean, I in the 10-year, I in whatever happens with the tax and spending bill, um, bank deregulation, um, and obviously the price of Bitcoin and gold are gonna tell a lot, a big story. So
I like it, dude. Everybody needs to go check out Heresy Financial. You want to give a little cliff note on your program or programs to come?
yeah, I mean, I always tell people to start off with my YouTube channel. That's where I put 99% of my stuff out there for for free, couple of videos per week. And then I do have a coaching program where I teach people how to invest, like, for themselves. I was a stockbroker for years, and I didn't like charging people for index funds, basically. And that's what the majority of the industry is. And so teach you how to do that for yourself, but also some more advanced stuff for hedging and increasing your
Asymmetrical
returns.
trades and stuff like that. Pretty cool stuff.
Yeah.
Joe, thank you so much for your time, man. It's been awesome.
Thank you for having me. It's always a good time.